Okay, good morning, everybody, and welcome to the Gulf Intelligence Daily Energy Markets webinar. I hope you all had a good holiday weekend in the Middle East, at least over the Eid Mubarak to everybody. And we kick off into August. Time flies when you're having fun, it seems. Well, I suppose the question is what's happened since we were last logged in and paying attention to the global markets. I think we'll kick off with Ed Bell, Senior Director, Market Economics at Emirates NBD. Ed, just to bring us up to speed, at the end of last week, there was a series of Q2 GDP reports come in. I was reading the Emirates NBD report this morning. It seemed to capture all of those details very well. If you might just share with us some of the headlines.
Sure. So, unfortunately, hardly anything to.
You're on mute, perhaps.
Am I still muted?
No.
Can you hear me?
No.
I can hear you.
Yeah, Ed, you're fine.
Yeah.
Go ahead.
Okay.
Go ahead.
Yeah. So, unfortunately, nothing too cheery to digest in terms of the outlook or the second quarter GDP numbers. We had probably most notably coming out from the United States was that the economy contracted by almost 33% on an annualized basis. It does seem unlikely that that kind of scale of contraction is going to continue going forward, given that we have seen in the start of Q3, at least, a lot of the states come out of lockdown. But nevertheless, the tentative emergence out of lockdown doesn't mean that we're anywhere out of the woods just yet. And some other indicators that we've seen out of the United States in terms of initial jobless claims ticking higher again does point to a pretty soft outlook for Q3. And that was, I think, the message that we got from the Federal Reserve at the middle of last week, the end of our holiday shortened week here in the UAE, is that they basically want to keep policy accommodative essentially ad infinitum as far as markets are concerned at the moment. When we look at the Eurozone, as a block, we had a 15% contraction in Q2 across the Eurozone economies, with some doing better than others, Spain and Italy being among the most worst affected, and Germany being the relative outperformer with a contraction of just a little bit under 12%. So pretty much no matter where you look as far as GDP data is concerned, Q2 was the real locus or real concentration of the effect of the pandemic in terms of growth and erasing, in some cases, a decade's worth of expansion in a single quarter.
I mean, it's kind of an extraordinary context to that number that you put into Emirates NBD report this morning for the Eurozone. The contraction was as big as the economic gains of the last decade. It's sort of a scale in which it's hard to kind of comprehend and probably unprecedented. How does it set us up for August, do you think, Ed?
Well, I think it leaves probably policymakers and consumers, I don't think consumers are probably too worried about the unprecedented scale of the GDP numbers, but more of the day-to-day safety of operating in wherever they're living, or the security of the job position that they're in at the moment. And I think we are of the view that the recovery looks a little bit more sustainable, at least in Europe, as far as the metrics that we've been able to track in terms of people resuming activity at almost normal levels of, sorry, I have a cat irritating here. Almost normal levels of activity coming back into to places like Germany or France. It's, I think, really the country that we're watching most directly is the US, where we had the expiration of the additional unemployment insurance top-ups from the federal government at the end of last week. We still have a political dispute in terms of trying to get a new measure of fiscal stimulus agreed between the Democrats and the Republicans. And I think that is going to be the big hang over the outlook for Q3 and going into Q4 as we go into an election as well. So I'd be still quite concerned about how well the recovery in the US takes hold and how sustainable it can be on a prolonged basis.
Omar Najia, Global Head of Derivatives, BB Energy. Omar, good morning. Eid Mubarak. And we saw oil prices, Omar, close at the end of July, the fourth month in a row. We have gains on Brent. What's your outlook coming out of this long weekend and obviously staring down the month of August?
Well, for Brent and TI, I think basically the long-term trend for both those markets is higher. In the very short term, we've moved off that low. We got to 44, something like that on Brent, about 42 on WTI, I think. So I think market corrects. The market corrects, like I said, and
I think we're having problems, Omar. Just the line keeps dropping in and out,
taking its oops.
Let's just go to Kevin while Omar maybe
I'm
fixes
still here,
that.
but the video's been switched off.
Okay, cool. Try again, Omar, with the video off. Maybe it'll give you more bandwidth. Go ahead.
No, it says host has disabled video.
Your handsome face is a bit overwhelming on a Monday morning, I think. Anyway, go ahead there, Omar. We can hear you now.
So I think basically, they both should correct that the trend is higher. So oil, the demand destruction that we've seen from oil was because of lockdowns. I don't think that's going to come back in any kind of large scale. So I think basically the demand destruction is done. So slowly and surely and gradually, I think market will tick higher. But I think a correction is if we close below $40 on WTI, I'd look for it to come off a little bit, maybe to the low 30s, and from there, I think trend becomes up again.
Kevin Wright, good morning, lead analyst APAC at Kpler. Kevin, thank you for joining us. If there is to be this sustained recovery Omar references, it's going to be on the back of, one would think, Asian economic recovery. Our number 2 story in the digest this morning is a report just out on Asia's factories gaining greater production levels last month. How does the outlook, do you think, for August from Asia's perspective, Kevin?
Good morning, Sean. Thanks for having me again. I think it's a very interesting question. As we see, China is recovering from this more quickly than other nations. I think there's a PMI statistic out as of either Friday or today that was obviously quite positive, and therefore China is sort of carrying the expectations of the region. But I think there are other parts of the region where we're seeing the pandemic still spreading. I mean, the Philippines, for example, over the weekend has approved a stricter lockdown around Manila. Japan is having problems as well. So yes, I mean, obviously the Chinese economy is significantly more significant than the Philippine economy, but all the same, when you take it into the context of the whole of Asia, we're not out of the woods yet.
Kevin, we also have another story regarding the Chinese oil imports that seem to be guiding that is slowing down. One of the great stories of this year, through all of the disruption, the Chinese oil imports remained at record high levels for most of the second quarter, but now finally does seem to be that party is over. What's your thoughts on the outlook for that?
Yeah, I think that's right. We've seen record flows and we've seen a record build. Inventory up at 880 something million barrels. It's very, very slightly down from the peak, which is around about 890 million barrels. And when you get to that level, and I've sort of made this point before, but you get to the point where the usable storage and the accessible storage is kind of full. Now, given that we've had the flows, we've had the inventories, etc., there's really not much space for that oil to go anywhere. So you're going to have to see a slight slowdown in the import level. On top of that, congestion around Shandong is still very high. Over the last few weeks, we've seen an excess of 50, 60 vessels waiting to berth and waiting for sometimes in excess of 23, 24 days just to be able to discharge. Now that obviously incurs demurrage. That means someone is paying for it. The buyer is paying for that cost of the vessel waiting to berth. So all of these things sort of compound and contribute to an inevitable slowing down of the imports. I think it was coming, but I think as we go into August, or as we're now in August and we go into September, we'll see the crude import levels come down to a more normal level.
Ed, looking out on these Q2 numbers, looking forward Q3, clearly one would one and one is two in the sense that Q2 was so bad that no matter what happens, Q3 is going to look great because it's going to have a heartbeat versus being in a coma. I mean, what's your thoughts on that sort of comparison?
Yeah, I think that's one of the tricks about digesting the data as we are still in the middle of the pandemic and the recovery underway, that yes, things are looking better now than they certainly did in April and May, but if we have recovery and I think Omar is correct to say that the scale of demand destruction has probably come to an end, but it's the point, if you had started the year, start of January 2020, you'd said that, okay, for Q3 and Q4, your best case scenario is that oil consumption is down 20%. That's still not a very rosy outlook, or industrial activity is going to be 20% down year on year from where we were a year ago. So for me, looking at the quarter to quarter transition, or when we look at the PMI numbers in particular, the way those numbers are assessed is to say, like, well, are you better or worse than you were the last month? Rather than saying you went down by 50% and now you're only down by 45%, that would show up pretty positively in a PMI or in a quarter-to-quarter kind of growth estimate, but still leaves the overall state of the economy in pretty tough condition.
Well, that would be a good headline for Donald Trump coming out of the third quarter, even if it might be misrepresentative of the reality. It would still be a pop-up headline that he would jump all over, I think. Omar, the earnings season well underway now. We saw all the major oil majors report last week with all sorts of terrible numbers, but ultimately the equity markets have held to the gains they've achieved over the last 4 months. What's your outlook there for the correlation between that and oil markets?
Well, I think basically I would just correct it a little bit. I don't think the equity markets have gone up. I think 5 stocks have basically gone up, where the rest have done very little, if not actually gone down.
Okay.
But I think basically the correlation, again, I look for oil to trend higher, and I look for the equity market to trend lower. The reason is, or certainly to be uninvestable. The reason is that the equity markets, the economy in the US has so much debt, is dependent on the Fed. Your consumer spending in the US and the real state of the economy is masked by this Fed largesse. The money that they're giving to consumers, the $600 a week, et cetera, et cetera. Some reports are saying it's actually more than some of the people who are receiving it actually make. So it's all this giant stimulus basically that's been spent. So that eases off as we go forwards. But not only that, the difference is whether you want to look at inflation, whether you want to look at a weak dollar, both of those are positive oil, positive commodities, and are largely negative, economic health, so to speak. So that's why I'm looking for a divergence between the two markets.
And the continued stimulus, how does it play into that?
Well, it's unaffordable. So basically, you can keep if a market becomes extremely narrow in terms of only certain participants are actually growing or making money or increasing their market cap valuation, whatever it is. And if all that is dependent on somebody saying, here's some more money, here's some free money, here's interest rate at 0, here's some money for consumers to spend, here's this, here's that. So, for example, tech stocks, right? So everybody's stuck at home. Everybody needs to buy whatever it is, a computer, an internet connection, a telephone, or whatever it is. So all because everybody's working from home. It's not, this is kind of spending that's kind of forced, as opposed to, you know what, I'm feeling so good now, I'm going to buy an iPhone 22 or whatever. So that kind of stuff eventually, shows up in numbers, so to speak. So I think all this stuff right now, all the data that we're seeing in tech stocks, tech spending, all that kind of stuff is more or less forced spending. So at some point in the future, that kind of spending is going to ease off. If the Fed doesn't continue to give people $600 a week, a $1,200, per person, one-off, or now it could be two-off payments, et cetera, these people will have, there'll be a lot of people who can't afford to pay rent. Unemployment is high. Unemployment numbers are picking up.
It does appear that the stimulus is successfully creating at least a perception that things are okay and I've got money. I mean, I look at the beaches in Brighton over the weekend in the UK, it looks like a big party. But somehow the dawn of realization that this is something close to a depression economically doesn't seem to be anchoring in the developed economies where the stimulus is on steroids. And maybe that's the purpose. It's doing its job. Kevin, meanwhile, back at the ranch, China and Trump and China, I should probably say, seems to be keen to keep drumming out those headlines. TikTok, much to my children's dismay, is the target of Trump over the weekend. It seems to be the latest in this big standoff. How do you see that playing out going forward? And do the markets need to pay attention? Once upon a time, China-US face-off was a huge issue for the markets. Less so now, it appears.
I think the markets are savvy enough to know that Mr. Trump is doing everything he can to take attention away from his COVID response, possibly to try and curry voter favor before the election later in the year. I don't think this will be the last of the reactions that we'll see from him. It's certainly not the first. It's not the most extreme. It's also not the most unrealistic. I think the markets sort of take these moves with a bit of a pinch of salt. I think we're starting to get used to the proclamations, the exclamations, and the tweets, and so on, and therefore the impact in terms of the markets, I think, of this will be relatively limited.
Does it still, given that point, kind of the boy who cries wolf, is it still making headlines nonetheless in Asia and Singapore's newspapers and so on?
It is. I mean, you've got to remember, I think, that media these days are so global that, whether it's in the Singapore media or it's in international media, the UK media, the US media, etc., people are still aware of it. But I think, at a certain point, it just becomes a little bit tiring, a little bit tiresome, I should say.
Yeah, I suppose where countries are, as we've talked a lot on this program, are forced into some kind of a trading choice between these two centers of gravity, China and the US, if indeed it gets to that. Let's bring up today's survey question before we go to the panelists for their outlook for this week. Brent posted a fourth month of gains in July. Will that continue in August? So that's a fairly straight and simple question. Will we see a continued rise of Brent and oil benchmarks in August as we've seen over the last 4 months? Post your votes and let's see where that goes. View in the room. So Ed, just looking now ahead this week, coming out of the Eid week, of course, that wasn't all over in the world, but there were some different holidays in different countries, bank holidays as they call them and so on. But looking into August, I'm kind of curious what your thoughts are. Most often August tends to be that quiet month when everybody runs off to the beach and does the usual shutdown, but it feels a little bit different this time. What's your outlook for this coming week and the longer month of August?
Yeah, well, certainly if nobody's able to take flights on their holidays anywhere, it's going to mean for more people at screens and probably trying to take a view in August. I think this week, though, we'll be tracking a couple of big central bank decisions. So in the emerging market world, we've got the RBI, which is scheduled to meet later this week, and the market is expecting to see an interest rate cut of about 25 basis points in the reverse repo rate for India. Inflation in India is one of the few countries where it actually been performing or been quite high, actually at the higher end of the RBI's target, but it has been trending downward. So we believe that it gives them the scope to be able to ease rates a little bit more. We also have decisions from the RBA in Australia and Bank of England where we don't expect to see any change, but probably something similar to what the Fed gave last week in terms of their assessment about linking, any movement in rates going higher would have to be linked to an improvement in underlying economic conditions, whether it's the unemployment rate or overall levels of inflation in those countries. And then at the end of the week, I think we'll be quite keen to digest the non-farm payroll numbers from the United States, which will reflect the tentative recovery. I mean, it seems like July was almost as long as a quarter itself in terms of starting the month very strongly in terms of the outlook for the recovery, and then coming back with a very strong resurgence in the number of cases in key states across the U.S. So be keen to see how the market interprets the non-farm payrolls numbers. I mean, already the rates markets in the U.S. are basically pretty much close to record lows, 10-year yield at 0.52, 0.54%. So extremely low levels.
And Ed, just on the final point, would you expect August from a markets engagement and watching point of view to be one in which you will see much greater involvement than normal?
Well, I think, whether it's August or seasonal or not, I think 2020 is shaping up to be a completely unique, or well, hopefully unique kind of experience. So the level of activity might be higher this year than we would have other seen in terms of trading volumes or activity in different markets. But I think that's more to do with the fact that conditions are so stretched and so volatile, or so at their extreme levels. No matter where you look at it, commodities, equity markets, interest rates, currencies, that, yeah, certainly August could be worth keeping an eye on this year if we do see some kind of seasonal snap from where we've been in the last couple of years. And probably, I think, it'll be a very key thing to watch if the persistent decline in the dollar extends into August.
Kevin, despite all of that, I mean, you could go to bed and not wake up for a week and oil prices would still be $43 on Brent and WTI something at 40 or 41. It's been dramatically stuck in the doldrums there. What's your outlook? What are you watching for this week?
Yeah, that's another interesting comment. I mean, given that we've seen 4 straight months of gains, and yet it seems like it's, everyone talks about it being in this range, and we see 43, and I know Matt Stanley's mentioned it a few times in his commentaries about, what's happened since yesterday, and not a lot. And so, I think, yeah, it's difficult to see. I mean, Omar's made the point as well. I mean, there is a gradual trend upwards here, but it's difficult to see anything really too exciting on that in the near term. Personally, what I'm looking at this week, as I look at most weeks, is inventories, floating storage, and forward curves. Because if China stops buying that crude that we've seen over recent months, then who steps up to buy it? And as I say, if the forward curves are not there to incentivize, well, they will have to change in order to incentivize that floating storage, because the oil is still going to be produced, probably more in August than was in July, basis the OPEC Plus comments of the last few days. And therefore, it's going to have an impact certainly on the depth of the contango, and that's really what I'm looking at this week.
Let's bring up the survey result before we give Omar the last word. Okay, a very divided room here. Brent post 4th month of gains. Will that continue in August? 47% yes, 53% no. So pretty much a divided room, but trending towards negative. Omar, your closing thoughts, what you'll be watching this week. We didn't even mention OPEC, of course, from the 1st of August, they were to add 2 million barrels to their production, or whatever caveat might be, 1+ million barrels. Nonetheless, more oil coming onto the market at a time in which demand doesn't seem to be there. Your thoughts for the week ahead, Omar?
I think basically, or what I'm hoping for is we get a dip on WTI in August. I hope it's somewhere like, the deeper the better, but I'm hoping for something like, $7. If so, it's going to be a big buy. So that's what I'm
anything that would trigger that correction, that would sort of be a moment that would say, okay, boom, it's going down?
Yeah, I think basically the market hasn't, the initial phase was explosively up, and then it's kind of, forming like this rounded top, like a kind of a head. So with kind of, I think we need to fall off. All the buying has been done, all the excitement, all the whatever, and now we've flatlined. So maybe people take profit, take money off the table, push the market lower, and then we start a new up. But having said all that, What I just wanted to say is August or July or any month since March, the volumes on equities or on oil have been tiny, have been smaller than I can ever remember. They're tiny. So there's not a lot of participation in these markets. So hopefully we can get,
What
large
does that
moves.
tell you by the thin
Everybody's
volumes?
sitting on the sidelines. So institutional money's on the sidelines, hedge fund money's on the sidelines. Everybody wants this. So in oil, if they see it crater, everybody buys it. In equities, if they see it crater, everybody sells it. US dollar, if they see it break support, soon, everybody sells it. If they see it hold support, everybody buys it. But everybody's sitting and watching. So I think
I suppose the price of gold and the price of Bitcoin tells you a little bit about that particular point, that there's still a great sense of concern because people are taking refuge in gold and Bitcoin.
Yeah, I love Bitcoin. But yes, I think basically people are, it's indicative of, if the market is telling you that volumes are very low, equities are, next to near all-time highs, NASDAQ is up, 20% for the year, gold is $2,000, Bitcoin is $11,000, and everything is up. It's just telling you that, there's too much risk, there's too much complacency, and there's too much money in the system. So at some point, something has to give. Either gold goes to 5,000, like I was saying maybe a couple of weeks ago, everybody's paying $5 for a Big Mac. In other words, the dollar becomes worthless, debt gets monetized that way. Oil goes to whatever it goes to, 200, 500, whatever. And equities, dependent on the rate of inflation, either go high or crater completely. So it's difficult.
All options on the table.
On the
Well, there's
table,
no doubt
exactly.
that I suppose we're probably one day closer, at least, to the inevitability. One might think that the dollar eventually becomes something comparable to, the Lebanese pound or the Argentinian, whatever. It does seem that this constant printing over the last decade, not just over the last 6 months, is going to finally have to come home to roost. And we'll hopefully we won't see that in our economic lifetime. But nonetheless, what I'll be watching in the coming week in August, I think, is more and more lockdowns. The fires are burning in so many different places that I think eventually it seems inevitable that they all join up. Talk over the weekend in the US, growing voices for a lockdown. All of the school systems and the universities are all declaring online learning from September. So if all the kids are at home, it is de facto a kind of a lockdown. Will it become a complete kind of April-May lockdown that we all live through? Well, I think the odds are growing on that. And then all markets will be impacted if indeed that turns out to be the case. So I'll be watching for any signals of further lockdowns from all, and I think because all economic activity then falls from that prism. But listen, thank you very much, Kevin, Ed, and Omar, and to everybody on the call. Have a safe week, have an economically productive one. We'll catch you here again tomorrow. All the best. Thank you.